I'm Aysha Medlin, and today I'm going to be talking about the Hyatt Hotel Corporation. Hyatt Hotel Corporation was founded in 1957 by J. Pritzker, and it started when he purchased the Hyatt House Motel owned by Hyatt R. Von Den, and it was located by the LA airport, and that's kind of how Hyatt got its original name. And so Hyatt's mission statement is to provide an authentic hospitality by making a difference in the lives of people we touch every day, including our associates, guests, and owners. So now that you know a little bit about Hyatt in general, I'm going to talk about the financial aspects of Hyatt. So I'm going to talk about the 5 main ratios we can solve for, and the first one is liquidity. And how I'm going to solve for that is I'm going to find the current ratio, and that is found by dividing current assets by current liabilities. So for 2016, the current ratio I got for Hyatt was 1.23 to 1, and then the current ratio in 2015 was 1.02 to 1. So you can see that they are able to pay off their current debts and obligations, but the ratio is not very high. So they are able to do it, but they could do better at that. And so this number does not look the best to creditors, but it does look good to owners. And then another way that I could determine the liquidity is through the acid test ratio. And this is found by adding cash, accounts receivable, credit cards receivable, and marketable securities, and then dividing all that number by current liabilities. And so for 2015 for Hyatt, I did get 1.18 for every $1 of liability, and then for 2016, I did get 1.73 for every $1 of liability. So once again, Hyatt is on the low side of the acid test ratio, and this number doesn't look the best for creditors because it does show that it takes a little bit longer for them to pay this off, but they are still able to pay it. But for owners, this is a good and positive number. The next test we're going to do is the solvency. And so solvency can be found through the solvency ratio, and this is found by dividing the total assets by total liabilities. And so solvency ratio I got for Hyatt in 2015 was 2.11, and then for 2016 I got 2.01. So this shows that Hyatt is doing a great job at paying off their long-term debts because creditors typically like to see a 2 to 1 or higher ratio, and Hyatt is definitely there, so they are doing good. There is always room to improve, but they are right there on the line where they are doing pretty great. So another way to test for solvency is through debt minus equity ratio, and this is determined by dividing the total liabilities by total owner equity. So for 2015, I did get 0.90 for Hyatt, and for 2016, I did get 0.99. So you can see that Hyatt is barely under 1 on that ratio, and this makes Hyatt more appealing to creditors because it does show that they do have low liabilities, and they can pay off those liabilities quicker. But owners do not like those lower numbers as much because it doesn't give them as good of a return on their investments. So the next thing we're going to talk about is the activity. So one way you can figure out the activity is through property and equipment turnover. So how you do this is divide the total sales revenue by the average property, plant, and equipment. So for 2015, I did get 1.05 for Hyatt, and then in 2016, I did get a 1.07. So you can see that the turnover is not very high, and they do have just a little bit more revenue than their total property and equipment. So they do need to work on being a little bit more efficient in that area. Okay, so another way that we can figure out the activity is by finding the asset turnover. This is found by dividing the total revenue by the average total asset. And so for 2015, I did get 0.55 for Hyatt, and then in 2016, I did get 0.58. So this shows that they are low on their asset turnover, and for every dollar in asset, there is only about 0.55 and 0.58 in revenue. So that is something else that they could work on. Next, I'm going to talk about profitability, and this is this is found by figuring out their return on assets, and you find this by dividing the net income by the average total asset. So for 2015, I got 1.58 cents per dollar, and then in 2016, I got 2.66 cents per dollar. So Hyatt also doesn't have the best return on their assets, because for every dollar they made, they only incurred about 1.58 cents or 2.66 cents. So they could focus on increasing that. And another way to determine the profitability is through profit margin. And this is found by dividing net income by total revenue. So for 2015, I did get 2.87%, and then for 2016, I did get 4.61%. So this is a low profit margin, and it shows that Hyatt only does make 2.87 cents in 2015, that's per dollar, and then 4.61 cents for every dollar of revenue in 2016. And so next thing we're going to talk about is operating. So to determine like the operating of Hyatt, we can do revenue per available room. And so this is determined by multiplying the occupancy percentage by the average daily rate. So for 2015, I did get that Hyatt had a revenue per available room of 168.18, and then in 2016, I got 170.27 for the revenue per available room. So looking at these numbers, you can see that the revenue per available room has increased since the past year. And this was about a $2.09 increase for the following year. So this is a good thing to see, because you can see that the revenue is increasing, so you know that your company is doing well. So overall, I feel like Hyatt is doing pretty well in this business. They're kind of right there where they need to be. There are definitely some things that they could improve on, which I've talked about through this whole video. And so, if they just made that, then if they just make those improvements, then I can see them being very great in the future, being very profitable, and expanding. Thank you.